Hey there. So, welcome to the SaaS Unbound podcast. Not Anna here today, but it's me, Tim Schumacher, your host today, joining for a special series where I chat with M&A experts about all things SaaS acquisitions. I'm one of the founders of SaaS Group, and we're a serial acquirer buying wonderful SaaS businesses to take them to the next level. And my very first guests are James, CEO at SureSwift Capital, and Don, founder of SureSwift Capital Inc. And yeah, to start things off, would be cool if you could introduce yourself and tell us a little bit more about what SureSwift does.
Sure, that'll start with me, I guess. Don Wharton, original founder back in 2015. Actually, the inspiration for SureSwift started years before that. I discovered a company called Internet Brands back in 2008. I think it was about 2008. Bob Briscoe was the founder. I really started digging in. It was publicly traded at the time, and I started digging into everything that he recorded and wrote. And the gist of the model was that he was buying companies that have existing cash flows and taking those cash flows and rolling them into new acquisitions and repeating that process. And it just seemed to me that I was in a business where we were trying to develop products and trying to make them popular and see if we can gain traction and see if they were sustainable and constantly trying to come up with new products. And of course, the success rate going that route is it's not close to 100%. But with buying companies that are already profitable, it seemed like you're already past that stage of viability and you've already got a substantiated model that's proven just because of the cash flows that it's generating. I really dug into that model and started making acquisitions myself. Bought a company out of Israel, out of bankruptcy, a technology company. Didn't have cash flows, learned a lot there. Bought another company that was a tool that helped to optimize PCs and learned a lot there. It did have some cash flows. And really, that's kind of where it started. Bought content sites at 9 months of cash flow. That was kind of in the old days when things were priced at quite a bit different than they are now. And over the course of about 5 years, there's a number of smaller acquisitions like that, up to about a $2 million price that we paid. And then by 2015, I met somebody that I thought would be a great partner, and we launched what became SureSwift. And our goal in the beginning was to raise a little bit of money, validate the concept that we knew what we were doing, and then go out and raise quite a substantial amount of more money and continue to make acquisitions. So that's where it started in 2015. Over the last number of years, we've made 40 plus acquisitions, and James was brought on in 2022 and really bringing experience and operations. And that was the beginning of really bringing in a team that understands how to make money in this space. On the surface, it looks like it might be something simple to do. You're just buying companies. But really, there's a lot more to it than that. And making sure that you're acquiring the right businesses and those cash flows are sustainable is a completely different matter. So here we are today with James as the CEO and an entirely new leadership team as of the last couple of years. And now it feels like we're just getting started again.
Yeah, I can give a quick overview of my background as well. So both Don and I are Victoria boys. So I went to the University of Victoria, did computer science and commerce on entrepreneurship. And while there with a couple other students, this was like early 2000s, decided to do a software company. And at that point, the internet was dead, the dot bomb. And so we decided to go into the life sciences space. And so we launched a company called Genealogics. And big story, but keeping it really short, we were producing software for life science research, genomics, proteomics, sold to universities, hospitals, biotech companies, raised angel investment, venture capital. Back in the day, you would have to fly out and deploy your software onto all these servers, and there's a bunch of crazy IT infrastructure stuff, and there's a heavy lift on training all these different customers because the user interface was just really bad, and it integrated to different instruments and stuff. But ultimately, we got acquired by a company called Illumina, leaders in human genome sequencing, in 2015. That was right when I turned 40. So that was a fun summer. And from 2015 to 2022, mostly like local and Western Canada, did a lot of angel investing, a lot of advising various software businesses and others, help them on strategy, help them raise future rounds. So I bring some deals to Don as well. One was like a personalized vitamin based on genetics and blood tests, and it was like subscription based. And I think he almost invested into that one, but he was more into like cash flow businesses. I was doing a lot of startup stuff. But in the summer of 2022, Don and I went out for lunch, and I was like not sure exactly where the conversation was going to go, but then just through conversation, a bunch of meetings and stuff, he brought me into a SureSwift Capital. So in the summer of 2022, and we brought in a new leadership team, and essentially to take SureSwift Capital to the next level and leverage mine and a bunch of other people's experience and stuff. So
So
two years.
what is next level? What is, can you share some kind of anything you can share, kind of some high level numbers, like what, like how big is the SureSwift conglomerate these days?
Yeah, well, I'll pass that to Don.
Next level to us, actually, let's back up a little bit. So the economy goes through cycles, and James and I through a few of those back in 1999. Went through a cycle where I learned quite a bit. Actually, I started with 75,000 invested in the market, turned it into 750,000 over 4 months, and then promptly lost that 750,000 and actually went negative. That was kind of a big lesson. You think that you're onto something, and the success that I'd achieved, I would think had something to do with me. But cycles are humbling. And 2008, 2009, something similar happened. 2020, of course, was something else entirely with COVID. And so having been through a few of those, it really emphasized to me that focusing on profits is something that always needs to be done. So next level is really focusing on what matters. It's not focusing on, I think, whatever story, sounds the best, whatever.
Absolutely.
It's not focusing on, I think at the top of a cycle, revenues, companies are valued on a multiple of revenues. And at the bottom of a cycle, companies are valued exclusively on a multiple of profits. And profits defined by cash flows, owner earnings, what the owner could put in their pocket each month. And so having gone through those and really kind of getting a sense of what SureSwift had accomplished, and we needed to kind of get ourselves aligned with what I believe to be an inevitability, and that's a different cycle. And, sure enough, shortly thereafter, I mean, we've experienced something now completely different, where profits are really all that matters. And the companies that are trying to make acquisitions and don't have the capital to do so are having a really difficult time. That's a much longer story. I'd love to talk about kind of what a company goes through with regards to the capital needs and how important capital is in this business, and how you've got to make sure that you've got capital at the right time when the deals are available and not just when everybody wants to give you capital. So next level is really operational excellence. It's really operating these businesses from an owner's mindset where the cash in your pocket at the end of the day or the end of the month.
So what profit margin are you aiming for?
James, what are we aiming for?
Every business is
20%
unique,
EBITDA margin, or 30, or what's
usually,
good?
Like yeah, for us, generally 40%.
40, okay.
And so that might feel high, and it depends on every business is
it depends
unique.
on the business.
But we have one of our tenants is a small high performing team can run circles around a big bureaucratic team, and so sometimes adding team members actually slows down the business, and so having the right people is just critical.
Absolutely. So you would interpret the rule of 40 as, zero growth and 40% profit is fine, or do you still expect a certain amount of growth, or is it really kind of depend totally on the type of business and which cycle they're in?
Yeah. I mean, every answer we give depends on many factors, but we're targeting like a 10 to 20% year on year. Some of our businesses we've grown faster than that, but in aggregate, a 10 to 20%
Yeah.
is a nice target. But most of the businesses that we're in are in competitive markets, and so we grow by just running them well and outperforming the competition.
I think generally, though, looking at the rule of 40, it applies to actually, it could apply to all the companies that we buy. You're right. I mean, if we buy something that's not growing, but it's got a 40% profit margin, that can be a wonderful business, as long as there's depth to the customer base and there's not too much over reliance on revenues from one particular customer. But also, we're not typically the acquirer of a company growing at 80% quarter over quarter or year over year.
Right.
If we did come across one of those companies and we're lucky enough to buy it, then by all means, we've got to make sure we're spending the money in the right places to really help drive that growth and take advantage of it. We're not just going to take the cash out of that business. We're going to make sure that that company is using as much of the cash as possible, but as long as it's driving growth. So we've got to measure what matters, and that's different for each business.
Yeah, no, I agree. I mean, founders who are growing 80%, they either get a lot of interest from VC and ultimately take it, for better or worse, in my experience, or they are just like, they're so heads down in their business and actually enjoy running it, because let's face it, I mean, if you double your business every year, that's usually quite exciting phase compared to the later phases when things kind of flatten out. Founders get a little tired. What do you think? Like, what are the main reasons kind of why founders sell? Because you're saying like those hyper growth companies, they don't tend to not come to you, and we see the same thing at SaaS Group. So what are the main reasons when actually founders come to you and are like, hey, SureSwift could be a good home?
Yeah, and just to say, like in some ways, Tim, we should be interviewing you, and so the answers we give, if you have like different perspectives or other things, for sure add to it. So we're buying businesses kind of in like we say like a 2015 vintage. So on average, businesses that have been around a while, still founder led, maybe team size is like 5 to 15 people, in like a few million ARR. And it's a good business. It's profitable, has happy customers, a good brand. It's kind of itched out its thing. It's growing, but not like, it's not rocket shipping. And so the founders are wanting to either sell all or a significant part of the business, partly to de-risk. So they have like a lot of their net worth in this highly risky one asset, so they're not diversified and across asset classes and such. Another one is they have a new idea. They're very entrepreneurial and innovative. The business is now, it's a going concern, but has like people challenge it.
They
like
want the excitement of the early MVP again, right? Like,
totally. Yeah. And actually, well, maybe I'll save it for later. So they have this next new idea. They want to take their learnings. So maybe they have a young family. There's actually quite a number of reasons. Often it's a mix of reasons. Sometimes like it could be they're burnt out, or they seek some kind of like future where they think the business could get capped or could start to decline. So maybe they see some kind of existential risk or perceived or new market entrants or.
Well, that's the thing you want to spot if that's really real. If the founder knows more, obviously, then
it's hard. They always
you are
know
us as
more.
acquirers. That's the
they know more about their business, way more than you do when you're looking at it. You may, hopefully, maybe you know more about SaaS businesses in general because you've been involved in many of them. But
But it's also interesting how often, at least from my perspective, and I'd love to hear yours, is how often you get this wrong. Like if I think about like some of the businesses where we really worried a lot, and probably the founders as well, and to your point, James, I think that diversification plays a huge role, because for us, it's a portfolio. For SureSwift, SaaS Group, it's just a portfolio, not just, but it's, of course, we don't have all the eggs in one basket, and for the founder, all the net worth is tied to the business, so he or she might just think very differently about risk. But it's interesting, kind of in retrospective, I think about the acquisitions we've done 4 or 5 years ago, and some we worried a ton about risk, and the risk just did not happen at all, and others we did not see any risk, and things just
Yeah.
went south.
So Tim, have you done much like angel investing and like a lot of
Yeah, I've done
startup stuff?
before SaaS Group. I've done 10 years of angel investment, and to be honest, that was actually one of my motivations for starting SaaS Group. Actually, I mean, all the other ones, Don, pretty much aligned with what you said. It's like why I started SaaS Group, but I to add one is I was frustrated with angel investments in a way. You give people money and you can't influence things, and you've got some brilliant founders where I've learned a lot, and they did amazing things, but there were also a lot of founders where it was just painful to see what they were doing, and so that actually was one of the reasons why I started SaaS Group, because I like to actually shape things and help founders take things to the next level. And with SaaS Group, obviously, we're super operational compared to angel investments where you're very passive.
Yeah, the reason why I asked about angel investing is like my experience with angel investing was like some you thought were going to do really well didn't for many various reasons. Others you're like, I don't know, like, okay, I'll invest because I want to help you out, whatever. And it's like, whoa, that's done really well. And so I think like with SaaS Group and SureSwift, there is some of that still. And you want every business you buy, like you want your full portfolio to do well. But there's so many unseen things and just things that are out of your control. So there's going to be some level of some businesses will overperform, some will underperform.
Do you have examples from your portfolio you can share to make it more tangible for the listeners? In a story that went really well, better than you expected, and another one where you were like, oh, this is not something you anticipated that way?
Yeah. Well, so Don's been at SureSwift longer than me, so I'll pass the puck. I'll pass the puck to Don.
So many things I want to pipe into, but
and interrupt as much as you want, Don.
Oh, no. Actually, just something top of mind. You asked, what is there like a sign when you're making an acquisition, if something's going to work out or not work out? Something that I've seen over the years that's a recurring theme is transparency. If you're talking to a seller and they give you everything that you ask for and more, that's a really good sign. If you ask for something and there's a reason or justification for not providing it, or it's not available and a number of things aren't available, that's also a sign. And I can think of a couple examples. I mean, we've been fortunate enough to acquire some 10x companies like a Back in Stock or parsers, AI solutions, mail parser and doc parser before AI was really a thing. And they really helped they had predictable growth that, we thought would continue, and it did continue. And we were lucky enough to get them at a price point that made sense. But we also added a lot of resources because it made sense to, because the inherent return on equity of each of those businesses, it justified continuing to reinvest in those businesses. And they ended up being, one of them ended up being about a 10x, and the other one about a 4 or 5x. On the other hand, I'm trying to remember the name of the company that we acquired, where the founder was a little bit more hesitant, but we ended up with providing information. And, that ended up being a sign later, because we ended up buying a company that we thought had a half a dozen employees, but had one. And that one employee,
that's a big misalignment.
It was totally a lesson, many lessons learned, actually. Do you contact the employees? Do you verify the email addresses? Do you, get signed notary statements? What do you do in order to prevent buying a company where you think there's a number of employees and then you expect to contact them after the fact, but it's really the same person? So, I mean, there was a reason why that person was not providing too much. But I mean, that was a huge lesson learned. Another time we bought a company where it grew too fast. It was growing really fast, and we changed our rules and based what we were willing to pay on a multiple of the last 3 months, because their trend was so wonderful. I think we've all been tempted to do that at some point. And if we don't do it, somebody else is going to come in and get what could be a great company. The data adds up. It's limited data, though. There's a reason why you want to have 12 months, I think, and base your multiple there. I mean, especially, I think that company was in the content space. So we bought a company and a multiple of the last 3 months, and it did amazing for about a year, and then nothing. So I mean, it's having a track record.
Why did growth stop then?
That was a content business. So if you've
content,
got
okay. So was SEO relevant, dependent on SEO or?
Yeah,
It could have
actually,
been like Google changes the algorithm.
Yeah. So
Back Panda, Penguin.
okay.
And-
So yeah, I mean that's I mean content businesses are notorious. I mean that of course you don't have that with SaaS.
we don't do that anymore. Yeah.
You don't do any content businesses anymore, right?
No, really, SaaS is
I think
lots
one thing
there.
there are like content site aggregators, and I can't remember the name, but there's like a really popular one based in Germany. Tim, you might know the name, but I think when SureSwift started, we were doing a number of diverse web businesses, but more and more we're like focusing on our sweet spot and the types of businesses we know and can run well, and more we're kind of shying away from ones that are great businesses, but probably better homes for other buyout firms and stuff.
Yeah, no, I agree. You need to know what to not do. I mean, we talked about product alignment, but what about cultural alignment? Is like how important is that for you? Because even if you have a SaaS founder, like from my experience, they can be totally different. I mean, there's SaaS founders err to the side of being actually quite honest, transparent, a bit nerdy people. So there is a certain type of people who run SaaS versus running a content site or running an e-commerce site. I mean, we all know the Amazon aggregators, which is a very different bunch of folks. But even within the SaaS world, they're more kind of the marketing people. They're the more introverted developers. And it's like, what's cultural alignment for you, and how do you assess it? How do you value it? Would you shy away from a deal because cultural alignment isn't there? How do you view that part?
Yeah, that's a very interesting question. With us, almost always the founders are moving on to a new project, and
you never keep the founders.
We have in the past, but our plan and our model is that
Yes.
we don't. But there's always exceptions. So we will, like, we have a fund model, so founders can roll some of the proceeds back into the fund and get distributions and diversification, et cetera. We have like a founders council in our next fund, and so our anticipation is one or both founders will move on, but we want to have them stay connected. There's a lot of value, but a lot of culture is top down from the leadership, and so like we assess the teams. But just understanding the leaders and who they were or are, that's a big indicator for the culture. When we acquire a business, like we try to retain the team and retain the culture, and like our belief is they've done a lot of good stuff, and so we don't want to like mess with things. But like over time, things do evolve and stuff like that, and so we want to make sure when the team joins SureSwift, we don't like all of a sudden burden them with all these new systems and processes and stuff. And we want their culture to align with us, so that they're not just going to be like, we don't like these new people. Like things have changed too much, and like we're going to go and we're just going to jump ship and stuff. And so, culture is really important. And so, about a year ago, we went through a big process of reevaluating our core values, which are a key part of our culture, and looking at like what we become and where we're going. So we have like 5 new core values that are woven into everything we do. And so part of the acquisition process is sharing about SureSwift and our core, like we will be sharing about our core values and making sure they're understood and stuff. So definitely culture is critical to understanding. Tim, what about for you and SaaS Group?
Yeah, I mean, same thing. I mean, we've canceled acquisition because we felt during the DD process, and by the way, we usually don't cancel acquisitions during DD. For us, an LOI is a handshake, and like if we don't find any major red flags during DD, we really...
You're always going to find some stuff.
You always find some stuff, but like we need to find something major to basically not stick to our word. And we really view the LOI as a word. But I remember 1 or 2 cases where we're like, basically, this just doesn't fit. The culture is so different. And that's then usually the cases where also the other side feels about this, but they're so in the tunnel of actually wanting to close that deal that they wouldn't say, like, you don't cancel a process as a seller because of that. But they feel relieved when we're like, hey, we really don't think this is working out. We're just so different. And then we've canceled those acquisitions. And usually someone else has picked them up who's a better fit.
I'll add that, one of the big things in that negotiation phase is kind of the cooperation, not just honesty, but the cooperation from the seller. True. And if they stop cooperating or it slows down and you can sense that, and maybe that's something different than if you're given, incorrect information. I mean, if a seller isn't honest with the information that they provide, that's something that you need to walk away from, I think. If it's something where the seller's passion is in the company and they're still passionate about it. They don't want to let it go and they start pushing back. That's another sign that, maybe stepping back could make sense. But I'll just add, as far as culture is concerned, really it starts at the top and, how the leadership team acts in the small things, even not just the big things, but the small things, with vacation time or saying what you're going to do and then actually following through and doing that. And just that integrity from the top filters down. And if at the top you figure out, who are you serving? Are you serving who's your customer? Are you serving, your investors, your shareholders? Are you serving the people, the community? Because they all matter. And in our business, it's capital intensive. We always need to be able to raise capital. So we really, in my mind, should be serving the interests of who's providing that capital to us, because our model doesn't work without it. So if everybody rallies around, the business model that's focused on what's in the best interest of the shareholder and the investor, then that's actually, a path that's sustainable. And if everybody rallies behind that, then, then you plug in, some of the benefits to the community or the team and such. But if you start with the team and say the team comes first, if you start with the community and say, we're going to, be the best donator of local charities and that kind of thing, that actually has an impact on the investors and shareholders and their returns. So start at the top, and really focus on what matters. And in our business, if it's capital, then we've got to make sure that the shareholders are prioritized, I guess, in the organization.
Yeah, I think a word a few years ago that I really grew to like is messy. And so what I mean by that is like these small businesses, there's often a lot of hair on the deal, and there's some messiness, and like the website looks really great. And talking to people, they're nice people and knowledgeable, but like sometimes how they do their accounting is messy, or like in SaaS is all about the data and in running the business. And there's like so many different ways data to collect and analyze for making decisions and stuff. But data is hard. It's actually way harder than you would think on the surface. And so they often don't have good data. They're missing things, all sorts of stuff. Just a bunch of things are messy in the business. And so us having seen a lot of things, like we expect there to be a certain level of mess. And so if the founders are transparent and open books and like, hey, we're doing this well, this we could do a better job at, like, we need serious help. Like we expect that. And if we're not seeing that, then that's like, if it looks too good to be true, these small messy businesses, then that's actually a red flag.
Yeah, no, I agree. There's always this cutting corners in small business. To us, it's part of the bootstrapper DNA, because if everything is perfect, then you're actually spending too much on tools and processes and data than you should as a small business. So absolutely agree. But yeah, being transparent is key, because those are easy fixes. I've found those, especially, you come in, you have certain processes, especially when it comes to HR, accounting, finance. So there are a lot of easy fixes on that, but you want them to really care about the core, the product. That's where you don't want to have messy stuff, but all that stuff around it can be a bit messy.
Yeah. One thing to note about SureSwift. So I think, well, actually two things. First one is, so I think SureSwift's a little bit different than SaaS Group in, like, we started as a holding company. and bought some assets, and then over time evolved to a management company with funds.
Right.
And so
With separate funds. True. That's
yeah,
that's an important difference to SaaS Group.
yeah. And so there's pros and cons to both models. And so our funds have different investor groups. So we're launching our third fund, and then eventually, like in a series of funds, we call these like our B2B micro SaaS funds. So we're launching our third fund, and then over time we're contemplating other series of funds, but that's like down the road. Maybe go up market or into. We don't have to get
Okay.
into that. And so each of our funds with the investor groups, we focus on growing the businesses, but we also give out monthly cash distributions to our investors, and those can be provide like high monthly cash on cash returns, roughly in the 15 to 40% annualized returns. So we have like a number of investors who like our funds because they're very complementary to like other types of venture capital or private equity funds,
Yeah.
which like you hold for the long
Yeah,
term
have
kind
a
of thing.
much
So
longer holding period.
yeah,
Agree. It's a
yeah.
good, yeah. And thanks for mentioning that, James,
Mhm,
because that is indeed an important distinction.
mhm.
Does that also mean that you don't hold the companies forever, that you're going to sell them at some point?
Yeah, good. That's
Or
a
what
great
happens at
question.
the end
So
of the lifetime of the fund? Or
yeah,
do you just keep
so
dividending out infinitely in an ideal
our
world?
funds are evergreen,
Okay.
and so they can go forever. We're generally not sellers of these businesses, so we like to like invest in the businesses, grow them for the long term. But we will divest businesses from time to time for a number of different reasons. Kind of sometimes maybe similar to why a founder sells to us. Like then at certain
Yeah.
points, maybe we want to de-risk or do different things with our funds. So when the investors invest into our funds, there's like a 2 year lockup holding period where there is some level of liquidity, but after those 2 years, then we have like a redemption process. So we actually have a fair bit of liquidity within our funds to our investors versus like a venture capital fund that you're in it until 10
10 plus
12 years
years.
down the
Yeah.
road.
Yeah.
So yeah, I just wanted to mention sort of our structure because it's a little bit unique
Yeah.
versus like holding companies or
Yeah.
venture capital or other private
Good,
equity. So
good point. Yeah. I mean, we're
um,
not a fund. I mean, the fund is obviously the standard model.
mm,
We're more like
mm,
Constellation,
mm.
basically a forever holding company. Liquidity will be provided if at some point either there's a secondary market or we go public. Until then, there's no liquidity because we reinvest all the money. Yeah, as you said, it has pros and cons. Each of the concepts.
Yeah. So I just wanted to highlight that, and then the second thing that I wanted to talk about is, and maybe you have good ideas for us, but so there's this tension between centralizing services versus like autonomy of the
Oh,
businesses,
great question.
and
We have
yeah,
the same struggle. It's like this is
yeah.
probably the most debated thing within SaaS Group is how much
Mm,
autonomy within the brands versus centralized
yeah,
services.
yeah.
And so, which services do you run centrally?
So we define it as like we call them corporate services,
Yeah.
and like as you mentioned, IT, HR, accounting, like cybersecurity, and like things of that nature, and some level of like strategy and business planning, and things that you get economies of scale by centralizing, and usually you're upgrading what the business was doing, and then the business functions. So the typical like go to market, product, customer success, those types of things exist in the businesses. So it's at a high level that's how we kind of separate it out.
Yeah, so same for us. It's interesting. There are a couple things which are kind of must-haves. I mean, there must be proper accounting,
Mm,
cybersecurity is like, okay, you got to do it. Nobody
mm,
disagrees there. It's interesting kind of when it comes to how much do those services cost? Do we really need all this?
mm, mm, mm,
Things when we run things like, I don't know, let's start SOC 2 compliance is like for
mm.
some brands it's totally worthless. For others it's like, wow, I can sell to enterprise.
Yeah.
And so there's quite a bit of debate.
Mm,
On those services within SaaS Group, and then we have some services which are voluntarily. So we
mm,
have competence centers, marketing, AI would be one,
mm,
product as well. Where if you're a small team, 5 to 15 people, you might not be able to afford like kind of this top-notch pay-per-click marketer, for example. So we've got this one guy who just basically runs pay-per-click for everyone. But there are some who just don't want to do pay-per-click marketing, and then they just opt out. And those are fairly easy. But still, there's always this constant debate: could we do this better or cheaper in-house, or not in-house, but within the individual brands versus through a central team? And definitely, while we're growing, we're about 300 people now. It's one of those big struggling points where people really also get quite emotional about it, because it's about freedom, it's about autonomy. And it's an interesting topic. It's probably one way we could do a separate session on how do you
And it gets back to culture, like the culture question too. So one way we think about it is like, when we acquire these businesses from these founders, they're like very innovative, and the next phase of the business is more like operational focused, and so we bring in general managers who are still quite innovative, but they are like more focused on operations, data, like that type of stuff, and it plays into like autonomy too. So, and you probably have this like across your businesses. Some leaders want a lot more autonomy. Some want things a lot more centralized or kind of like dictated top down, and there's like everyone sort of in between. The PPC, so we consciously decided to not have internal experts within the corporate company around, like say PPC. They either exist in the businesses, or we use like freelancers and agencies. And then we just share and track like which ones are doing well, and like we share it amongst. But it's kind of hard, because then there's like, with a PPC expert, then there's like utilization rates and like chargebacks to different businesses.
That's the tricky thing. At the same time, with freelancers, we have the problem. I mean, there is also a lot of junk out there. So we've seen brands who just, I don't know, get some random dude on Upwork, and we're like, well, you know, we really know that isn't working, and then how much do you let people?
I've had success on Upwork. I've had.
Oh, absolutely. I didn't want to imply that there's no success on Upwork, but in some cases, you really it pays to have a standard and to have someone really good on this. But it's also there's no right or wrong in this question, because if you err to the side of autonomy, then I think your model is definitely superior. And so it's a constant balancing act, as you said earlier.
Yeah, and so like on that, where we've gotten to, and we're still like, is this the right approach? So we say the businesses we call it like a semi-autonomous model, and so with the business functions, they have autonomy. With the corporate functions, they don't. But we have a framework where they can sort of like cross-pollinate and collaborate. And then like one of our core values is win together. And so don't just focus on your business. We have like ways that they can like share knowledge and all of that kind of stuff. So we think it's working, but we're going to, like, probably the same as SaaS Group, you continually monitor and iterate.
Yeah. And then you said you benchmark the companies against each other. What is going well? What isn't going well? In the respective areas. What are the main things you benchmark, apart from kind of the obvious ones, revenue, churn, LTV, those sorts of things? But what are kind of the health metrics you think are important to look for?
Churn is just crazy important. And so there's like a number of different metrics around churn and revenue expansion too, in terms of like resource allocation as well. And so a number of the businesses we acquire, they're spending like 70% on 80% on product, and maybe like 10 to 20% on customer success, and maybe like 5 to 10% on actually like go to market. And so
you're shifting that a bit.
We balance that out a bit. We balance it out a bit more. So on the cost side, on some of the high level SaaS metrics, and in terms of investment too, like how they're making investments. So each of the businesses makes a bunch of run rate investments in terms of like go to market product and customer success and stuff. But then when they want to do bigger investments, then we have like a higher bar. It has to be like documented. How are you going to measure ROI? And it's hard to make some of these, like hard to attribute return on some of these investments and stuff like that. But yeah, we're tracking like which businesses are sort of like investing beyond typical run rate stuff. How about SaaS Group?
Pretty similar. I mean, it's one of those
Mm,
areas we're also trying to figure out. There's some areas where we have a lot of health metrics
mm,
on the business. I mean, the on the revenue side, I think you named all the obvious
mm,
ones, and
mm,
they're of course the most important one.
mm,
Then I think there are a lot of things on the customer service side, on just kind of response times, also pretty obvious things. What we're digging more and more in is like people metrics, so kind of the
mm,
health of teams, productivity of teams, lots of engagement metrics, really kind of what makes a healthy team.
mm,
Also reflective of the leadership which is in place in both the central teams as well as the individual brands. But we're now trying to go further. Cybersecurity, good example
mm,
you mentioned earlier, kind of measuring like what makes a brand secure. Like where are their security metrics? Where's something a green light versus yellow or even a red light? Kind of really trying to expand that throughout the entire functions we
mm,
have in a company. So marketing, everything. You can have those health metrics everywhere, and that's I think it's a super interesting thing because I think one of the big benefits of both of our models
mm,
compared
mm,
to
mhm,
individual founders is that we see a lot of things. We see what is good, what is not good. As an individual founder, you're sometimes struggling. Is like, is this what
mm.
I'm doing? Is this really good? What's best practices? So yeah, the beauty of aggregation is that you can measure those things.
Yeah, yeah. No, I agree with you. And like we think, okay, this particular business that we own, it's in a hyper competitive market. And so
Yeah,
some of the competitors are founder led businesses that are scrappy,
right.
working around the clock, or others are like venture backed and have a ton of capital. And so like what's our competitive differentiation in that? And I think it's the aggregation model and the learning, the cross pollination, and to some level top down, thou shalt do certain things around cybersecurity or things of that nature. But it would be easy to be overbearing on these small businesses with all these checklists of all these things thou shalt do, and then slow the business
Yeah.
down and bureaucracy. And so we're very careful and tracking like the autonomy and the speed of these small businesses versus like the top down, and
Yeah,
it's
cool.
tricky. Yeah.
Good. So we probably could talk about
Yeah. Yeah.
operating SaaS companies for hours. Let's
Yeah.
maybe move to one last topic, which is kind of always the elephant in the room, which I found with negotiating with founders, and I'm sure you have
Mm,
the same, is valuations.
mm,
Is what's your take, and also a little bit the state of SaaS M&A in 2024 is
mm,
like, what are you seeing in terms of valuations? What are trends in the market? Of course, we all know that every deal has to stand on its own, and there's a wide range of everything. But we see certain trends, and what you think is gotten more important. Don, you mentioned earlier that in a downturn, profitability is more important. So I think that's certainly a trend. But just kind of on a high level, you also look at a lot of SaaS companies. What are
mm.
you seeing at the moment? Changing valuations, different topics seeing on the markets, the competitive environment of other acquirers.
Mm.
What are your takes? What are your conversations with founders around valuation on those trends?
Don, do you want to take this one first, or should I?
Generally, I mean, clearly, just going back to my example before, where we were looking at content sites that were selling at 9 times cash flow. That was a different time. Now I think back at that time, it was about 2 to 2.5 times cash flow that SaaS companies were trading at. Now, I mean, you're not going to get a great SaaS company at 2 to 2.5 times. Times have changed.
Yeah.
Clearly,
Mm,
valuations are pushing up. Um, but sellers, great companies can still be found, and sellers sell for reasons other than cash. I mean, they've got a legacy. They want somebody to look after their company. They want their team to be looked after. They want their communities to be served, and really, what it comes down to is if you've got a great operator operating your business that's operating it in a profitable manner, that company's going to be around for a long time. But if you're acquiring a company and then you're kind of swinging for the fences in everything that you do, that company might not be around for a long time. So I think there's something to be said in a message to founders that If you've got a company that's a great operator that really knows what to look at, digs into the data and figures out, what's going to not just, make the most sense for this business in the short term, but the long term as well, then I think there's a lot to be said there. So it's not just a matter of valuation, like multiple of profits. It's the bigger picture.
Yeah.
And
Great.
quite often, if a founder's values are aligned with ours, and we're on the same page there, we want this company to be around for a long time, then maybe there's other factors that'll weigh in, and that'll always be the case. And I think there's still plenty of deals out there to be had. It's just a matter of having the money to make those acquisitions in a tough environment, and I believe you guys do, and we do as well.
Right. How many companies did you acquire this year?
We're not acquiring right now. We're about to launch Fund C. So over the last couple of years,
fundraising, and then once you have that, you're going to be back in the acquisition game, or
exactly.
Yeah. So with the new leadership team joined 2 years ago. So we actually, like, in our second fund, we paused the capital calls and returned some of the capital to the investors, just to spend the last 2 years focusing operationally on SureSwift. And that's a whole series of podcasts on the work we did. But so we're just at the first close of our third fund. And so we're talking to some really awesome SaaS businesses, but we're just setting expectations. Like, we're going to do our first acquisition later this year. Okay. Timing wise, does that work for you and stuff? So we're having conversations, and that's nice, because for some of these businesses, they want to get to know you too, and it takes the time. Like, and we want to get to know them. Gets back to the culture. Yeah. But if a deal comes through a broker and it's competitive and stuff, then we just decline.
Yeah. Okay.
Yeah.
Okay, cool. No, I mean, that makes sense. Also, funding is a bit cyclical. So it means that if someone is out there, individuals, they could go and contact you about investing in SureSwift.
Yeah, for sure. Absolutely.
Good.
Yeah.
Okay.
Probably contacting me. And so this sort of 2-year pause on new acquisitions, just focusing on who we are and how we work together. But in the future, the plan is when one fund is deployed, the next fund is ready. So there isn't going to be this pause.
Cool.
Yeah.
Super exciting. Yeah, no, that's really cool. It's interesting to hear about some of the similarities, also about some of the differences. But it seems like we're in very similar playing fields. Maybe at some point we'll even do a deal together, or start some companies or something. We also, same as you, we usually don't sell companies, but we have sold one where we felt it's a better fit somewhere else, and frankly we just didn't get it to grow, which was a bit of an anomaly. But maybe there's something to do.
And I think there are sort of more and more companies that are buying SaaS businesses and apps and stuff. But there's also far more businesses and apps that are in the market as well. And I think so. Yeah, I think I've been looking at SaaS.group for the last couple of years. What are they doing? Trying to learn from you and read blogs and stuff. And so thank you for sharing and doing podcasts, and thank you for inviting us on the show.
Yeah, well, thank you for taking it. It's great, because not all SaaS companies are public about what they do. Some prefer to be super secretive, but we believe it's about sharing. It's about the community out there.
Totally.
Founders who learn from this, if they want to sell, or also if they don't want to sell. So thank you very much for doing this and sharing your stories and being
come out to Canada. Come out to Victoria, Western Canada, and we'll take you mountain biking and canoeing and snowshoeing and
sounds
all that
fantastic.
Awesome.
Thank you very much.
Yeah, thank you. Cheers.
Thanks, Tim.